Right. Now we are going to start AAT 1 Financial Accounting chapter number 2. Right. Now chapter number 2 is a very important chapter because the learning you are getting here, it will be tested in the exam as well as you are going to need it for the following chapters. Okay. Right. Let's look at what are the things that we are going to learn here. So we are going to learn a beautiful, the fundamental of our accounting equation. We are going to learn about the accounting equation, and not only that, the double entry system, our core, our base, we are going to learn, and very importantly, the 14 accounting concepts we are going to learn. Right. So these are the areas that we are going to cover in chapter number 2. Right. Let's start with the most predominantly important area, accounting equation. Right. Now if you try to understand and the concept of an equation, you know that in an equation, guys, we have two sides, right? Two sides. In an equation we have two sides, and what we demarcate in an equation is one side is equal to the other side, right? Now we are going to apply this equation concept to accounting. Now in accounting we are going to use an equation and say one particular element is equal to another type of an element, right? So we'll try to understand this one. So before we learn accounting equation, okay, we need to learn few important accounting concepts, and then we'll gradually move on to accounting equation. This accounting equation is connected to accounting elements we will learn, right? So before that we will learn a fundamental basic accounting concept, right? Let's look at. Okay, for us to learn about the accounting equation, we need to know this accounting concept. What is this accounting concept? It says business entity concept, right? Business entity concept. What is that business entity concept says? Very, very nice and a very, very fundamental concept, because this concept shows the main ethic of a business as well. Let's see what does this concept says. This concept says, look here, when it comes to accounting, the business and the owner are two independent parties. Now most of the people, when they start the business, they always think as, okay, this is my business. You know, sometimes the people phrase, no, it's my car, right? My petrol. Then whatever the things I do, then nobody should be caring about it. Others should mind their own business. This is my business. That is the mentality, no, which is wrong, right? Which is pretty wrong when it comes to the accounting. Right? Even the people who do the business, they need to change the mindset, and they need to understand business is separate and me as the owner, we are separate. Right? That is the fundamental. That is where we separate the owner's assets, owner's liabilities, owner's things separately, business income, business asset, business expenses separately. Fundamental, right? So the business entity concept says business and the owner are two separate independent parties. Now why are we saying, right, for the accounting equation, business entity concept is important? The reason is, let's say I am the owner of a business, right? Let's say I am the owner of a business. Now we know that as per this concept, owner and the business are two different parties. Now I have pumped money to this business. Right? Now I am the owner, I have given money to the business. Let's look at from the business point of view. I am the business. I got money, even though it is from the owner, I am committed, I am obliged to pay it back. That's the beauty of it. Someone can think, okay, this is the owner's business, why should I commit to him? Right? It's his business. No. Owner separate, business separate. Owner has put money to the business. I have a commitment, I have an obligation to settle it back. May not be immediately, even at the end of the business. I have to settle it back to the owner. So I have a commitment, I have an obligation towards the owner. It's an internal obligation, internal commitment towards the owner. We see that as equity, the capital, the equity. Equity is an internal obligation of the business to the owner to pay him back. Clear? That is created through this business entity concept. So owner and the business are two independent parties. Right. Now, for us to learn the accounting equation, we need to know the financial statement elements. We need to know the financial statement elements. Now you know the financial statement components. The 5 financial statement components you all know. What are the 5 components? Statement of financial position, statement of profit or loss, right? And the statement of changes in equity, statement of cash flows, and the notes and the disclosures are the 5 components that you all know. There are 5 elements as well. What are these 5 elements? You all know, don't worry, you all know. Now, first of all, we'll understand what are the 5 elements, how it is connected to that 5 components. Then we'll learn each one of these and we'll try to understand the equation behind these 5 elements. Okay? Right, let's look at what are these 5 elements. You know these things. Assets, liabilities, equity, income and expenses. Assets, liabilities, equity, income and expenses. Some of you might think, okay, I don't know what is an asset, what is a liability. Don't worry, we'll learn. Right? Assets, liabilities and equity is connected to the financial position. Statement of financial position. Okay? And income and the expenses are connected to the financial statement of profit or loss or the income statement. And what do we do from the financial position? We actually assess the financial position of the company. What is the meaning of financial position? Financial position is how much of assets are there with the business. If you take a business, okay, this is the business, how much of assets are there? And what is the commitment towards the owners and to the external parties? Now we purchase these assets through the money given by either the banker or the owner. No? So how much of assets are there? How much of commitment back to the bank or the lender or the external party, and how much of commitment is there to the owner. This is what we call the financial position. And the statement of profit or loss is provided in the financial performance, your profitability. How do we calculate the profit? Profit is calculated as income minus expenses. So that is what we call the financial performance. Okay? Right. Now what are we going to do is, first of all, we will take assets, liabilities and equity, try to understand what are the meanings of these with all the examples and everything together. Then we will learn the accounting equation. Then we will connect income and expenses to the equation and we will expand the equation. I hope you are clear with what we are going to do. Okay? Right. We look at a question, 2019 January. Which one of the following group contains the element of income statement? You know, the elements of income statements are income and the expenses. Pretty easy, right? Pretty easy. Right. So let's start learning about an asset. If I asked you to give an example for an asset, right? Give me some examples for an asset. For assets, you might say land. Yes, land is an asset, right? And the buildings, the machines, right? This is a paper printing machine, is an asset. Equipment, then softwares, right? And the furniture, right? Computers, all these are what we call assets. Now, let's try to understand the definition of an asset. This is something that you need to remember, right? Definition of an asset. Asset is defined as a present economic resource. Asset is defined as a present economic resource. What is the meaning of present? Present means you need to have it right now. Now for an example, let's say you had a car. You had a car, right? You purchased a car many years back. Thereafter, you sold it. Can you say it's an asset of yours now? No, right? So it's gone. You don't have it right now. It's not your asset now. Another thing, let's say you are expecting to buy a car. You want to buy a car in the next year. It's not an asset now. If it needs to be an asset, if it wants to be an asset, you should be having it right now. It should be a present. What is the meaning of economic resource? Economic resource means by using that asset, you should be able to generate economic benefits. Right? What is the meaning of economic benefits? Economic benefits means either you are generating a cash flow or any other asset. At the same time, either you are reducing the cash outflow. Now, for an example, right, we'll take a building. By having a building, you can generate a cash flow, isn't it? By having a building, you can either rent it out or you can sell that building. You can use it for your business purposes, right? You can generate a product, you can offer a service, and you can generate an income, right? So in order to be an economic resource, you should be generating an economic benefit, or there should be a reduction of an expense. Now, for an example, earlier you used to be in a building and you were paying a rental. Now you are in your own building, therefore you can save that rental. Therefore, the building will become an economic resource. Let's say you have a motor vehicle. Right? How come it can become an economic resource? You can earn money. You can ride Uber, you can ride Pick Me, right? You can put to a rent-a-car service, you can do the deliveries and earn something, right? At the same time, you can use it for your business and earn something, or you can save your cost. Earlier, you used to go on Uber, you used to go on a Pick Me, you used to go on a public transportation service. Now it's your own vehicle, so you can save some money. That'll create an economic resource. Are we clear? So asset is something you are having it right now, and it's an economic resource. You are generating an economic benefit. Clear? And how this asset was created? Asset was created as a result of a past event, right? Result of a past event, and it is controlled by the entity. Let me take it separately. Asset was created as a result of a past transaction or an event. Let's take a building. How you got that building? Because you purchased it. Have you got that building? Because you constructed it. Have you got the motor car? Because you purchased it. Right? Have you got that software? Because you created that software, you developed that software, or you purchased that software. So that is the past event. The purchase, the construction, the creation, the development is the past event. So assets are created as a result of a past event. And very importantly, it should be controlled by the entity. Now, what is the meaning of you are controlling something? For an example, let's say, guys, you have a motor vehicle and you are controlling it. What does it mean? Controlling means basically two things. Controlling means, Lamai, right? It has two things. One is decisions. Other one is benefits, right? If it is your motor vehicle, you should be taking the decisions. Let's say it is your motor vehicle, but your neighbor is always taking the decisions. Neighbor is always saying where to park and where to pump the fuel and where to get the repairs and services, where to insure. Everything is decided by the neighbor. Then it's not your car, it's neighbor's car. Right? And the second thing is who's getting the benefits. Even though it's your car, it's always been used by your neighbor, right? He or she is always taking it and going here and there. You are not been informed, and you have to travel by the public transport, even though it's your vehicle. So then you are not controlling it. If you are controlling something, you should be taking the decisions. You should be obtaining the benefits. You should not allow others to take decisions. You should not allow others to take the benefits. So, in order to be an asset, it should be under your control. So, if it is a land, you are taking the decisions, you are getting the benefits. If it is a building, you are taking the decisions, you are getting the benefits. If it is a motor car, you are getting the decisions, you are taking the benefits as well. Okay, right? So basically, in order to be an asset, these are the three, the definition parts. Asset is a present economic resource controlled by the entity as a result of past transactions and events. Easy, and you have to remember, right? So these are fundamentals. Clear? Right. We look at a question. Present economic resource controlled by the entity as a result of past event are assets, right? Assets. Okay. Right. Let's look at the characteristics of assets. There are three main characteristics of assets, right? Let me explain it. First one is right. Right? First one is right. Right means there should be an entitlement, there should be an hold. It need not to be always a legal right, because in accounting we look at the economic reality than the legal reality, right? So the right can be a legal right or a leasehold right, right? Both can be accepted, or a rental right even. What we are looking at is, do you have the right to receive money? Do you have right to receive economic benefits? Whether that is there, right? Second one, right, ability to generate economic benefits. You should be having the right, you should be having that ownership, either legal ownership or a leasehold ownership, that should be there. Second one, there should be an ability to generate economic benefit. There should be a cash flow. Like I told you, that economic resource thing, you should be able to generate an economic benefit. Third one, like I told you earlier, the control. You should be taking the decisions, you should be benefited. Okay, right. So the right means right to receive money, right to receive goods or the service, right to exchange resources, right to use that particular property, plant and equipment. Property, plant and equipment. Here the PP refers to property, plant and equipment. Property means land and building. Plant means machinery, and the equipment. Right to receive money, right to receive goods and services, like that. Ability to generate cash flows and other assets. I have explained the control. Ability to obtain economic benefits and the decisions. Clear? These are the three characteristics of an asset. Right, economic benefits, control. You should be owning it legally or on a leasehold basis. And when to recognize. Now, you know what is an asset, what are the characteristics of an asset, and when to recognize. When can we put a double entry in the books? When can we record that asset in our financial statements? In our financial books, when can we record it? There are two criteria we are looking at. First one, when we are recognizing an asset, Lamai, you should be getting economic benefit. There should be probable economic benefits. Probable means, Lamai, more than 50% chance. There should be a more than 50% probability chance there will be a cash flow. Economic benefits, in a simple term, it's cash flow. Or it can be any other assets as well, but in simple terms, it will be cash flow. That means there should be more than 50% chance of getting a cash flow. And you should be able to make a reliable estimate. The cost or the value should be able to measure reliably. Exactly what is the value? Okay, for an example, you purchased a land. Now this land is a present, you have it now, economic resource, you are getting benefits. As a result of past event, you purchased it, control. You are taking the decisions, you are enjoying the benefits. Now we need to book them in our accounts. In our financial statements, we are going to book it. So you need to ensure you are going to generate cash flows. You should be more than 50% sure. Yes, definitely. I am going to sell the land, I am going to earn some money. Second thing, cost or the value shall be measured reliably. You should be able to measure the cost or the value reliably. Let's say for me to purchase the land, it cost me 10 million. Now I have that figure so that I can record. Okay, right. Then the classification of the asset, Lamai. We learn this in the future as well. Basically, assets can be classified into two types as current and non-current. The meaning of this current and non-current is, current means any asset which can be realized. Realized means converted into a cash within a period of 12 months, right? If an asset can be converted into cash within a period of 12 months, such type of assets are what we call current. If assets are taken more than 12 months, we say non-current, right? Let's see. So assets are classified as non-current and current. If it is taken more than 12 months to get realized, non-current. Less than 12 months, current. Okay, right. Then even the non-current assets, there are different types. One type is the property, plant and equipment, like I told you. Property, plant and equipment include land, building, motor vehicles, then furniture, equipment, fittings, like that. Then there are intangible assets. Now these are tangible, no? Land you can see and touch, building you can see and touch, right? And maybe the equipment you can see and touch. And there are intangible assets such as software, websites, right? The patent rights can be there, the license can be there, right? The quotas can be there, right? So there can be certain intangible assets as well, right? So the land, building, like that, software, patents, even the investments and the fixed deposits, you cannot see, you cannot touch. You can say, okay, I touched the fixed deposit certificate. That is only the document, not the fixed deposit, right? So it's an intangible asset. Current assets. Current assets are the assets which can be realized within a period of 12 months, no? It includes the inventory, trade debtor, your trade receivables, inventory within a period of 12 months you can sell and cash, no? Debtors, when you sell it on a credit basis, it will create a debtor. Right now, for an example, I am selling items to you on a credit basis 100,000. Now you are going to be my debtor. I am supposed to collect 100,000 from you. I am supposed to receive 100,000 from you. So you are my debtor, right? So the inventory, the trade receivables, other receivables, prepayments. If you are making a payment in advance, that's a prepayment, no? And the cash and cash equivalents. Your cash in hand, your current account balances, your saving account balances, right? Treasury bills. These are what we call cash equivalents. Okay, right. So let's see a question from 2024 January paper. List two examples of assets that can be classified as non-current assets. Very easy, right? So they are asking the non-current assets. Two examples. It can be land, it can be building, it can be machines, it can be equipment, it can be investments, it can be motor vehicles, it can be software, right? So any two examples would be fine, right? So now we know what is an asset. Asset is a present economic resource as a result of past events which is controlled by the entity, right? Now after the asset definition, we are going to move towards the liability definition. Now let's look at the liability definition. Liability can be defined as a present obligation. Liability is a present obligation. Once again, the word present means in order to be a liability, you need to have that obligation now. Obligation means commitment to repay, no? Commitment to repay, commitment to settle. You have a present obligation. You are obliged, you are committed, and you should have it now. For an example, let's say you are planning to obtain a bank loan. Are you presently obliged? No, right? It's something in future. It's not a liability. You had a bank loan which you settled already. Then it's not an obligation. The current bank loan you are still paying, that is a liability. So Liabilities is a present obligation. And what is the obligation towards to? Like I told you, obligation towards to pay, obligation to settle. The obligation is to transfer economic resources, obligation to pay in cash. Economic resources are the assets. Economic resources are the assets we just learned. When you are settling the bank loan, you are paying in cash. Cash is an asset. When you are settling the bank loan, sometimes you have to give away your property, which is an asset. Your present obligation, you are presently obliged to transfer, to settle an economic resource, to provide an economic resource. Clear? Present obligation to transfer economic resources, once again, as a result of past transactions and events. How come you got a bank loan? Because I signed the loan agreement. How come you have a trade creditor? Because I purchased items on credit. How come you have a bank overdraft? Because I signed the OD agreement. How come you have an accrued liability, accrued electricity bill? Because I consumed electricity. How come you have a salary payable? Because I got the service from the employees. Clear? So because of a past transaction, because of a past event, it creates a liability. Okay? So liability is a present obligation to transfer economic resources as a result of past transactions and events. I hope you got the idea. Right? Okay, let's once again we'll look at what are the characteristics of a liability and what are the examples as well. Right? In order to be a liability, following characteristics should be there. We'll look at the first one. There should be a past event. Now, if you look at this past event, it can be a legal event or a constructive event. Sometimes, due to the law, you have been obliged. Now, for an example, you are signing the loan agreement. It's a contract, no? For the employees, you are supposed to pay EPF, ETF. It's a law, right? So, there can be legal and even constructive because of your practices, because of your policies, it might create a liability. For an example, bonus, right? So, the bonus payable, you are supposed to pay employees the bonus. There's no law as such, but that is a customary practice of the business to pay the bonus, right? Maybe the warranty claims, right? Now, when you are selling the product with a warranty, when the customer comes back, you have to, do that rectification. No? You have to honor that warranty. No? That is the company's practice or the company's policy. Companies has made a statement. So, there's a past event which creates a liability. It can be legal or constructive, right? Which creates a past event. And there will be outflow of economic resources, right? There will be outflow of economic resources. And it will create a present obligation. Past events are there, the legal and the constructive, and a present obligation. Currently, you are obliged to settle. You are presently obliged, right? So, you have to settle it. There's no way out. And the outflow of economic resources, right? So, there's a past event, right? A legal event, it can be an agreement, it can be an act, it can be the legislation. Because of a past practice, because of a policy, you accept the responsibility. Present obligation. Because you have accepted that responsibility, now you are supposed to pay it, you have to settle it. You are obliged. You have to settle it. You are presently, you are obliged, you are committed. And we are going to settle it, and there will be a cash outflow. There will be an asset outflow. Outflow of economic resources. It can be cash or any other asset. You have to give away. Right? So, past events, present obligation, outflow of economic resources. These are the three features or the characteristics of a liability. Right. Let us take some examples of the classification of liabilities after this question. Right. 2020 January paper will look at. State whether each of the following statement is true or false. Write the answers in your booklet. A criteria of a liability generating future economic benefits to the business. Here they are using the word generating. Generating means inflow, no? Liability is not an inflow, it's an outflow. So this is a false statement. False statement. Okay. Right. So let's move on to the liability classification. Like we did in the assets lamai, liabilities even can be classified as current and non-current. What is the meaning of current? Current means if a liability is supposed to be settled within 12 months, current. If a liability is supposed to be settled after 12 months, non-current. Okay. If an asset will be realized within 12 months, current. If a liability is settled within 12 months, current. If an asset is realized after 12 months, non-current. If a liability is settled after 12 months, non-current. Clear? Right. So accordingly, we can classify as non-current and current. Non-current. What are the liabilities you are supposed to settle after 12 months? Bank loans. Thereafter, we say the maybe the gratuity liabilities. What is the meaning of gratuity? There's an act called Gratuity Act. If an employee has worked for more than 5 years, when that employee leaves the company, you have to pay him a compensation. That compensation is half a month salary into number of years worked. Right? So that is a long-term commitment. And sometimes companies are issuing preference shares, companies are issuing debentures, right? There can be different types of loans, mortgage loans, like that. Bank loans, mortgage loans, debentures, leases. Sometimes we take the leasing facilities. Those are long-term liabilities. It takes time, right? Short-term loans, short-term liabilities. Bank overdraft is a short-term. Trade creditor, when you purchase items on credit, it's a short-term one. Then the accrued liabilities, that means the payables, electricity, water, salary, tax payable, like that. Trade payables, other payables, accrued expenses, tax payable, bank overdrafts. These are what we call the current liabilities. Okay. Right. Now we know what is an asset, what is a liability. My assets are basically company's resources, right? Assets are the resources you are having right now, and you got it due to a past transaction, and you are controlling it. You are getting the benefit, and you are using it, and you are directing it. Liabilities is because of a past transaction, you have got a current commitment, and because of that commitment, there will be a asset outflow, cash outflow. That's a liability. Okay. Then there's another thing called equity. Equity is the internal obligation, internal commitment, the owner's entitlement, the amount we are supposed to pay it back to the owner. Now, we know that business and the owner are separate things now. Business is supposed to pay the owner's money and owner's entitlement back to him. No? That commitment, the internal commitment is shown as equity. Right? Equity is the residual interest after deducting liabilities from assets. When it comes to a business, we need to understand business belongs to the owner, no? But the other external parties, liabilities, we have to prioritize always. Now, for an example, let's say business is there. Owner has pumped 1 million. They took a bank loan of 2 million. Now, business is going to close down. First of all, they have to settle the bank loan because bank loan is an external party. They are not in the business. So we should not be looking at the own internal parties first. First of all, the external parties, then internal parties. So from the assets, first of all, you have to deduct the liabilities. Then whatever the remaining belongs to the owner. That is what we call the equity. From the assets, first of all, deal with the liabilities, the external parties, external commitments. The remaining part belong to the owner. That is the owner's internal commitment, equity. So how do you calculate equity? Assets minus liabilities. Assets minus liabilities. In other words, we say the equity is the residual interest, but whatever the remaining after deducting liabilities from assets. Okay. And even we say equity is the net assets. Why? Asset minus liabilities is the net assets, no? Right? So we say the net assets is also the equity. Now we know what is an asset, what is a liability, and what is an equity. Now we can create the basic accounting equation. So let us move on. Now this basic accounting equation, right? It starts with the equity. You know, the equity is the owner's entitlement, the internal obligation towards the owner. Now, when we start a business, owner is initially pumping the money, so that creates an equity, the business's commitment towards the owner. So, equity, that is the residual interest after deducting liabilities from assets. Then, after equity, we have taken the external funding or the external liabilities. For an example, it can be a loan, it can be a credit purchase, it can be a bank OD, like that. Now, equity is the commitment towards the owner from the business, and the liabilities is the commitment towards the external parties, right? And both of them together, the total shows the total commitment or the total obligation. And we say that is equal to the assets, right? Now, the total commitment, total obligation to settle it back is equal to our assets in the business. What does it mean? How are we going to tackle it? Right? Let me explain. Now, equity is the internal funding obligation, right? And if you look at the liabilities, external funding obligation. So basically, this shows how we have been financed, the financing obligation, right? Financing obligation, okay? And this financing, internal and external funding or the financing obligation, we are making it equal to the investment in resources, right? Basically, this aspect shows how we got money. Think from the point of view of a business, how we got money. How we got money from the owners, how we got money from the external parties. And the other side of it, the asset shows where have we invested that money. අපිට සල්ලි ආවේ කොහොමද? අයිතිකාරයා කීයක් දුන්නද? ණයට කීයක් ගත්තද? අයිතිකාරයා දුන්න ගාන අපෝ දෙන්න එපයි. ණයට ගත්තේවා අපෝ දෙන්න එපයි. ඒ සල්ලි කොහෙද දැම්මේ? ඒ සල්ලි දැන් මොකද වෙලා තියෙන්නේ? assets වල කොහෙද තියෙන්නේ? So basically, the basic accounting equation is assets equal to equity plus liabilities. What does it say? It says your financing obligation shall be always equal to your investment in assets. ඔබට මූල්‍ය ගලාගෙන ආපු ආකාරය පිළිබඳ ඔබට තිබෙන බැඳීම ඒ මූල්‍ය ආයෝජනය වී ඇති සම්පත් වලට සමාන විය යුතුයි. Otherwise it won't work, no. අයිතිකාරයා සල්ලි දැම්මා, මෙන්න ඒකෙන් බිල්ඩින් එකක් ගත්තා. එහෙනම් බිල්ඩින් එක සමාන වෙනවා අයිතිකාරයාට දුන්න සල්ලි වලට. ඊට අමතරව ඔන්න ණයක් ගත්තා. ඒ ණයට ගත්තා ස්ටොක් එකක්. එහෙනම් ණයයි අයිතිකාරයාට ගෙවන්න තියෙන බැඳීම සමාන වෙනවා ස්ටොක් එක ප්ලස් අර බිල්ඩින් එකට. තේරෙනවද? That is how the basic accounting equation works. This is the base, this is the fundamental. So this is what we called basic accounting equation, right? Assets equal to equity plus liabilities. In other words, financing obligation equal to investment in resources. Okay, right? Let us do a small question, right? And I'll be starting from the scratch. Okay, now we know we'll start from the scratch. At the beginning of whatever the business, you don't have the liabilities. No, you start with equity. When you start a business, right? When you start a business, more or less, right? There can be some businesses starting with the loans, but more or less you are starting the business with the owner's money. That is equity. When owner pumps money, the business has a commitment to repay that to the owner. That is what we call the equity, and that equity is equal to the assets. This is the starting point. This is the starting point. Okay. Now we'll see then how it works in the transactions. Then gradually we'll bring the liabilities as well, right? So we'll take a simple example. Mario started iTech Computers, which is the name of the business. Mario is the owner, by investing 5 million in cash. Now let's put that into the equation. Still we don't have liabilities, right? So equity now, the business has got 5 million as equity. Business has got 5 million as equity, and business has a commitment and obligation to repay that 5 million to Mario. The Mario has invested 5 million, so that internal equity is there. And that 5 million is available as cash in the business. That is the asset. So you can see this 5 million is the commitment to repay back to the owner, right? So the 5 million you got cash and you have a commitment of 5 million to the owner, right? Let's see another expansion of this question here. iTech is a business. They have purchased a building by paying 2.5 million, right? Now this your equity stands still, no, 5 million. What is happening to the assets? they earlier had 5 million cash. Now half of which they are going to utilize for the building. So the cash comes down, building goes up. So building 2.5 million, cash 2.5 million. Cash comes down, building goes up. Okay, right. Then it says iTech purchased 2 million worth of computers. 2 million worth of computers. Now what will happen? The equity remains still. They has a build-in of 25 million, 2.5 million. They had cash to the value of 2.5 million. Of that, 2 million comes down, inventory goes up. Inventory 2 million, cash only 500,000. Cash only 500,000. Okay, now you can see it always your equity and the resources, that equation, that balance remains, right? Then iTech sold computers costing 2 million for a value of rupees 3 million and earned a profit of rupees 1 million. Right? Profit of rupees 1 million. Now building 2.5 million remains the same. They had inventory to the value of 2 million. That 2 million inventory is gone now. Right? Inventory is 0 and they are getting cash to the value of 3 million. Earlier they had 500,000 plus 3 million, total cash together is 3.5 million. Now, by selling 2 million worth of an inventory at a value of rupees 3 million, you are earning a profit of 1 million. We all know that in a business always profit belongs to the owner. Business is running it, but the profit belongs to the owner because the owner has pumped money and started the business and he needs a return. That return is profit. So profit we have to repay back to the owner. So that profit will be part of your equity. So the capital 5 million, retained profit 1 million. Okay. Right. Then the next transaction, it says the owner made a drawing. What is the meaning of drawing? Right. When owner is taking the business money for his personal use, when the owner is taking business assets for his personal use, we say it's a drawing. Is it okay to do that? People are doing that. That's okay because, if I am the owner of a business, if I have invested money, I have to make a living and I have my expenses, I need money, right? So out of my entitled profit or part of my capital, I am supposed to withdraw. Otherwise, I can't run my life, no? So owners can draw money, owners can draw assets, that's okay, right? So the owner has made a drawing, the money taken out of the business by the owner of rupees 200,000. Now let's say what will happen. Building remains the same, inventory is already 0. Cash, they got 3.5 now. So 3.5 will come down to 3.3 million. 3.5 minus 200,000. Now then what will happen? Earlier, can you remember, owner pumped money 5 million and owner was entitled for a profit of 1 million. Of that profit now owner is withdrawing 200,000. So the owner's entitlement, right, the business's commitment towards the owner will come down by 200,000. So equity capital 5 million, retained profit 1 million, drawings which is a minus, which is a reduction of the equity 200,000. Now we are going to expand. Now earlier we just had a business of equity and the assets only, no? Now here comes the external commitments of the external liabilities, right? So the equity plus liabilities is equal to the assets. This is our basic accounting equation, okay, right? Let's move on. iTech, the business, has obtained a loan of 600,000. Now let's see what will happen. When you are obtaining a loan, the liabilities will increase by 600,000, right? Building 2.5 million, cash, what will happen? Earlier it was 3.3 plus the loan value of 600,000, it became 3.9 million. Equity remains the same, 5 million, 1 million profit and minus 200,000 drawing. Okay. So you can see still we are maintaining that equation balance. You can see there's a dual impact, right? When you are taking a loan, one side the cash goes up, other side the loan balance has increased. So you can see when owner invests money, cash goes up, owner's equity capital, owner's commitment towards the owner to the business of the business is increasing. So whatever the transaction, there are dual impacts, right? So that also we will figure it out. Let's see another transaction. iTech purchased 1 million worth of computers on credit. Now, other than the loan of 600,000, you have the creditors worth of 1 million. Creditors worth of 1 million, right? So then you got the building inventory will increase by 1 million, cash 3.9 million. Equity remains the same. You can see when you are purchasing items on credit, one side inventory goes up, other side the liability towards the creditors goes up. Who's a creditor? When you are purchasing items on credit, you have a commitment to repay to that person, no? That company, no? That is what we call the creditor. That company or the person will become a creditor. Mario invested another 500,000 in iTech. Then what will happen? Building, inventory, cash will increase by another 500,000, right? This is 3.9 million, 500,000. And equity capital, earlier it was 5 million, now there's an additional capital invested, so it went up to 5.5 million. Retained profit 1 million, drawings minus. Liabilities will remain the same at 600,000 plus 1 million. iTech sold computers costing 400,000 for 750,000 on credit. Now we are selling on credit. When you are selling on credit, it will create a debtor. Let's say this is the business. This also you need to understand. When you sell on credit, whoever the credit customer is what we call the debtor. This credit customer is what we call the debtor. When they purchase items on credit, that credit supplier is what we call the creditor. Okay, that you need to understand, right? Okay, now let's see what will happen here. Building 2.5, inventory. Earlier you had 1 million, now we are selling 400,000. Inventory comes down by 400,000 and the debtors will increase by 750,000. Cash remains the same. Now, difference between the cost of the inventory versus the sale value will become a profit that will be added to the retained profit. Here, retained profit will be added by 350,000. The creditors 1 million and the loan balance remains the same. Right. Okay, I think we had a good idea about how the business equation works, the basic accounting equation works. Right? You can always see they are keeping that balance between the financing commitment versus the investment. In other words, assets equal to equity plus liabilities. Let's do some questions. Okay. Following transactions are occurred in Manuka's business for the month of December 2024. Show the impact of above transactions to the basic accounting equation. Right, let's see. Manuka started the business by investing 500,000 as capital. When you are investing in the business has an internal commitment obligation to the owner, so that equity capital will increase by 500,000. And that 500,000 is an asset, no? It's a cash balance. So the 500,000 cash will be increased. Right. Second one. Now you can see that dual impact. Okay. Second one, business purchased 300,000 worth of goods on cash. When you are purchasing items on cash, one side your inventory will increase. On the other side, your cash will come down. When you are purchasing items on cash, cash will come down, inventory will increase. Your equation remains the same, right? There's no impact. Purchased an equipment for the office use at a cost of 50,000. You are purchasing equipment for the office use at a cost of 50,000. So what will happen? By 50,000, your office equipment will increase. And by 50,000, cash will come down. Rent income received 5,000. When you are receiving a rent income, what will happen? As a result of receiving the rent income, the cash will increase. And as a result of the rent income, your equity, your profitability will increase. So that will be added to the owner. The profit will increase now due to the rent income. Okay. Right, let's see another transaction. Purchase goods worth of rupees 200,000 on credit. So purchasing 200,000 worth of goods on credit. When you are purchasing the items, the inventory will increase. And you are purchasing on credit now. So the liability will increase by 200,000 called creditor. Right, creditor. Okay. Sixth item. Sold goods costing rupees 50,000 to rupees 75,000 on cash. When you are selling items, the inventory will come down. Inventory will come down by 50,000. And you are getting 75,000 cash. And the difference between these two will become a profit. You are selling 50,000 worth of items on 75,000. So the profit will increase. Profit will increase by 25,000. Obtained a bank loan of 400,000. When you are obtaining a bank loan, the cash will increase. Cash, when you are obtaining a loan, you are getting cash, no? On the other side, that 400,000 you have to repay, no? So there's a commitment to repay. So the loan balance will increase by 400,000. Loan is a commitment. Number 8. Sold goods costing 100,000 for 150,000 on credit. When you are selling the items, the inventory will come down by the cost. And you are selling it on credit, therefore a debtor will increase. By selling 100,000 worth of items at 150, you are earning a profit of 50,000. You are earning a profit of 50,000. Invested 50,000 in a fixed deposit. When you are investing in fixed deposit, one side your cash balance will come down. From the cash you are taking this money, no? On the other side you are getting a fixed deposit. So the fixed deposit will increase. Cash comes down, fixed deposit will increase. Rupees 10,000 worth of cash was taken by Manuka. Manuka is the owner for his personal use. When you are taking cash, your cash balance will come down. And owner is taking the money, no? So the amount we are supposed to pay back to the owner, our internal commitment towards the owner will come down because we are supposed to pay. Now owner is taking money, no? So minus 10,000, equity will come down because of the drawings. Okay. Rupees 20,000 cost of goods were taken by Manuka for his personal use. When you are taking goods, the inventory will come down. Inventory is the stock or the items. And which is a drawing, so the owner's entitlement will come down. Drawings. Okay. If you want to watch, you can always pause the video and check your answers that you can do. Manuka introduced an additional capital of 200,000 to the business. When you are introducing money, your cash balance will increase. And because of that cash, the commitment will increase by 200,000, the capital. Salary paid to the employees of the business, 50,000. When you are paying the salaries, cash comes down. And salary is an expense which will reduce the profit. The profit will be reduced due to expense. Electricity of the month, rupees 5,000 has not been paid yet. So electricity you haven't paid yet, but electricity is something you have consumed. You have consumed electricity but you haven't paid. So there's a concept called accrual concept. Accrual concept says whether you paid or not, if you have obtained, the transaction has happened, you have to account for it. So electricity is an expense which will reduce the profit. So the profit will be reduced due to this electricity expense. It is something you are supposed to pay. So the accrued electricity, or in other words, electricity payable will increase. Accrued electricity or the electricity payable, which is a liability, right? You have consumed the electricity, now we are supposed to pay. So it's a liability, will increase. Bank loan installment of rupees 15,000 paid, of which 2,000 is interest. Okay, so the bank loan installment you are paying 15,000, 2,000 is interest. When you are paying, definitely the cash will come down. And the exact repayment of the loan, you are paying 15,000. Of this 15,000, 2,000 is for the interest, which is an expense. No, interest of the bank loan is an expense. That is for the passage of the time you have to pay something. No, bank is also bank is giving some other people's money. No, right? Therefore, bank is charging an interest. So that it is our expense. The remaining repayment of the loan is 13,000. Repayment. So because of this interest expense, the profit will come down. Profit will come down due to the interest expense. Loan will come down by 13,000. When you repay the loan will come down. Interest income of rupees 1,000 received from the fixed deposit. When you are receiving income, definitely the cash balance will increase. And this interest income will definitely increase the profit. So plus 1,000, profit will be increased due to the interest income. Rupees 20,000 paid to the creditors. Rupees 20,000 paid to the creditors. When you are making the payments, cash comes down. We are paying to the creditors, so the creditor's liability will come down. Right, there's one other transaction. Rupees 30,000 was received from the debtors. When you are getting money from the debtors, one side, cash will increase and the debtor will come down. Debtor will be reduced. When the debtors are paying you the money, cash will increase and the debtor will come down. Okay. Right. So there's another question, and I'm always encouraging you to do these questions, then check your answers. The owner introduced 100,000 to the business. You have to put them to the basic accounting equation. So once again, the cash will increase. This is owner's money, so our commitment towards the owner, the capital will increase. Purchase goods 20,000 on credit. When you are purchasing items on credit, one side your inventory will increase. Since you are purchasing on credit, the creditor's liability will increase. Paid rupees 8,000 to the creditor. When you are making the payments, cash will come down and the creditor's balance will come down. Sold goods on credit for rupees 10,000. When you are selling the items on credit, one side inventory will come down, right? Sold goods on credit 10,000. Here they haven't mentioned the cost of the items. Let me put it. I'll amend the question. Sold goods on credit for rupees 10,000. The cost of the items is rupees 8,000. So please change the question accordingly. Sold goods on credit for rupees 10,000. The cost of the items is rupees 8,000. Right. So when you are selling the items, inventory will come down. You are selling it on credit. Therefore, the debtor will be created for 10,000. So accordingly, 8,000 worth of items sold at 10,000. You are generating a profit of 2,000. Profit of 2,000. The owner paid his personal mobile bill mobile bill for rupees 1000 from business bank account. When the business money is used, the cash balance will come down, right? And this is basically a drawing because owner is using business money to settle his personal expense, no? So it's a drawing. Equity will come down by 1000. Obtained a bank loan of rupees 100,000 at 12% interest rate. So when you are obtaining the loan, cash will increase, and on the other side, the loan balance will increase. The owner introduces private vehicle to the business worth of 200,000. So business is getting a vehicle worth of 200,000. This is given by the owner, so the owner's equity capital will increase by 200,000. Because owner is putting this vehicle and we are supposed to pay back that value. So the equity capital will increase. Paid the rent 1000. When you are paying the rent, cash will come down. And rent is an expense, it will reduce the profit. Profit will be reduced due to the rent expense. Loan interest paid. So we have to do a calculation. It was 1 million loan at 12%. So it will be 12,000, right? So 12,000 interest paid. When you are paying the interest, cash will come down. Loan interest is an expense, so minus 12,000. Profit will come down due to the interest expense. Receive from the debtors rupees 5,000. When you are receiving money from the debtors, cash will increase and the debtors will come down by 5,000. Debtors will come down by 5,000. Right. So we have done 2 questions with a number of adjustments. Let's try to do some past paper questions. 2020 January paper, assets plus 150,000 minus 140,000, equity plus 150,000 minus 140,000. Which one of the following is the most correct transaction for the above accounting equation? Right? Goods costing rupees 140,000 was sold for rupees 150,000. Goods costing 150,000 was sold for rupees 140,000. Goods of rupees 150,000 were sold on credit basis and collected 140,000. Goods of rupees 150,000 were purchased on credit basis and paid 140,000. Right? Let's see what are the items. Right? We'll take the last one. Goods worth of 150,000 were purchased on credit. So this is not the answer because there's nothing on liabilities. Goods 150,000 was sold on credit basis and collected 140,000. So 150,000 was sold on credit, then the debtors will increase and collected 140,000. The cash, then there should be, cash is receiving, debtor comes down. So this information is incomplete and that is not there. Goods costing 150,000 were sold for 140. No, that is also not the answer. No. When you are selling 150,000 worth of items, it should come down. 140,000 should be the plus. If this is the case, this is minus, this is plus. So which is not the correct answer. So the correct answer is the first one. Goods costing 140,000 were sold for 150. So 140,000 stock comes down, 150,000 cash goes up. The net result, 10,000 is added to the profit. This is your sales. This is your cost of sales. This is the profit. Okay? Right. Let's see 2020 January question number 1.8. Which one of the following transactions affect increase in assets? Owner of the business has invested 1.5 million in cash as an additional capital. Month of March water bill 75,000 was paid. Right? An amount of rupees 100,000 was collected from a trade debtor. An amount of 125,000 was settled to trade creditor. Right? We'll take one by one. First one, when owner is investing money, one side asset increase, other side the capital increase. So definitely this is a correct answer. Month of March, water bill paid. When you are paying, cash comes down, no? Not an increase in assets. An amount of 100,000 was collected from a debtor. When you collect from the debtor, cash goes up, debtor comes down. Net impact is 0 to the assets. An amount of 125,000 settled to creditor means you are paying. So the assets will come down. Increase in assets, no? So the first one is the correct answer. 2020 July paper, let's see, 2020 July. Select from the following the correct impact to the accounting equation when the owner of a sole proprietorship transferred his personal motor van to the business. Increase in equity. When we are transferring the personal van, one side the van will increase, no? On the other side the equity will increase. Let's see. Increase in equity and decrease in assets. Nope. Increase in assets, decrease in equity. No. Increase in liability, not relevant. Increase in assets and increase in equity, which is the correct answer. 2020 July 1.10. Assets increased by 200,000, equity increased by 200,000. Which one of the following is most correct transaction for the above accounting equation? So we know that assets equal to equity plus liabilities. We'll take one by one. First one, owner has taken 200,000 worth of goods for his personal use. When owner is taking money, it will be minus 200 and minus 200. So not the first one. Owner has paid electricity bill of 200,000 of the business. When owner is paying the electricity bill, that will be an additional capital. But on the other side, electricity bill is a expense, so that will be a reduction. So then it is not even the correct answer what we are looking at. Right, we'll look at the third one. Additional cash of 200,000 was introduced by the owner to the business. So cash goes up, equity goes up. So which is the correct answer. Next one, we'll see the fourth one. 200,000 worth of goods were purchased for resale on credit basis. So 200,000 worth of goods were purchased. When you're purchasing, yes, 200 goes up. Credit basis, no liabilities. So it may not be the correct answer. Right, 2021 January. Which one of the following transactions leads to increase in assets? Here they are saying increase in assets. Purchase 100,000 worth of goods in cash for resale. When you are purchasing the assets, definitely the assets will increase by 100,000. Paid an electricity bill, assets will come down by 50,000. Purchase a computer worth of 100,000 for office use on credit, right? Here they are purchasing the items on cash. Sorry, so the inventory goes up, cash comes down. Sorry, so the net impact is 0. First one, no? Sorry, cash, no. Purchase a computer worth of 100,000 for office use on credit. So when you are purchasing a computer, the computer will increase by 100,000, and a creditor, the other creditor, the liabilities, other creditor liabilities will increase by 100. So the asset increase, this one is the correct answer. Owner of the business has taken goods. When owner is taking the goods, assets will come down. So may not be the correct answer.